Welcome to the session. I hope you have revised the class, what we have done on deductions last time. What we are going to do is we are going to finish off the deductions part today. And we had completed till ATC, right? We have finished till ATC. ATC, there was only one aspect which was remaining, which was on the ULIP, which is what we are going to discuss now. Okay. So let's get quickly started because we have to finish off the chapter. Okay. So what we have to discuss now is on the ULIP. Now, under ATC, if you remember, I have given you the list over here. So we have contribution to LIC, contribution to ULIP, premium for contract of deferred annuity, PF, SPF, RPF, Sukanya Samriddhi account, subscription to NSE, tax savings FD, tuition fees for university, repayment of principal portion, stamp duty charges, bonds of NABARD, senior citizen savings scheme, tax saving mutual funds. So all of this is allowed as deduction under ATC. Now, in respect of ULIP, there is an amendment. Now, what is that amendment? Let's try and understand. Okay. So now, if you remember, under the head capital gain also, there was one amendment with respect to ULIP under 45(1)(b). If you remember, we have done this under 45. I'll just take you quickly towards that so that you have the link to the topic. So if you remember 45(1)(b), what did it provide? That where any person receives any amount under the ULIP to which exemption under 1010D does not apply, which is if the premium is greater than rupees 10 lakh, right? Then the amount allocated by way of bonus and the amount received, which is there, will be chargeable to tax under the head capital gain and shall be deemed to be the income of the previous year in which the amount is received, right? Now, Rule 8AD was prescribed for that. What did Rule 8AD provided? Rule 8AD provided that where the amount is received for first time, then the amount received minus the premium paid is your capital gain. Are we clear? Now, what does the amendment under 80D is providing? Sorry, 80C is providing. Let's try and understand. Okay. So, contribution to the ULIP is allowed as the deduction under ATC. Any sum which is received on the LIC as well as on the unit linked insurance plan is exempt under section 1010D. Is exempt under section 1010D provided the value of the sum premium paid does not exceed 2,50,000. If it is lesser than 2,50,000, then you have the exemption under 1010D for any sum received on account of LIC or on account of the unit linked insurance plan, right? Any sum which is received. So any sum received which is there under a life insurance policy is exempt. What is not exempt under 1010D? Keyman insurance policy is not exempt. Keyman insurance policy is not exempt, right? So if the value of the premium in case of the unit linked insurance plan, if the amount of the premium payable for any of the year is exceeding 2,50,000, then the exemption will not be applicable. Then the exemption will not be applicable. Are we clear? Then the exemption is not applicable. Now, there is also one more condition under 1010D for the availability of exemption of LIC. Right? There's an additional condition in respect of the LICs issued, which is that, if you remember, I told you in ATC that the sum, the premium paid should not exceed 10% of the sum insured. Premium paid should not exceed sum paid 10% of the actual capital sum insured. So any sum received under LIC is exempt. However, exemption would not be available if the premium payable for any of the years exceeds 10% of the actual sum insured. And where the insurance is on the life of a person with disability, as referred to in ATU, or a person who is suffering from disease as referred under 80 DDB, then the premium should not exceed 15% of the sum insured. Right? And for ULIP, what is the additional condition? For the ULIP, the additional condition is that exemption under 1010D would not be available with respect to any ULIP if the amount of premium payable exceeds 2,50,000. This is only for ULIP. This is only for ULIP, right? However, if it is received on the death of the person, then exemption would be still available even if the premium exceeds 2,50,000, right? Now, exemption, as I said, is not available for two things. Exemption is not available for two things. One is under Keyman insurance. Keyman insurance, if you remember, is taxable for employer under 28.5, and for the employees under salary under 70, and for any other person under the income from other sources. Also, if the dependent disabled is there, if there is a dependent disabled in respect of whom an individual has paid any amount in the scheme of LIC and he dies before the LIC matures and the other individual receives the amount, then that is also not exempt. Now, keeping all of this separate, okay? Now, here the point is that, as I said, for the ULIP, if it is exceeding 2,50,000, then the deduction is not available to me. And for the normal insurance premium, which is there, the amount of premium should not exceed 10% of the capital sum assured. Is this very clear? Very, very clear? So 1010D, for ULIP, you will remember these provision 1010D, which provides for exemption for the sum received, but the premium should not exceed 10%. However, for the ULIP specifically, there is 2,50,000 limit which is there. Right? Now, understand one thing. CBDT has issued the guidelines through a circular. CBDT has issued the guidelines through a circular. And what the circular has provided? There's the circular number 2 of 2022. Circular 2 of 2022, you can write it down. Which provides the guidelines for exemption of the proceeds received under ULIP or taxability or exemption of proceeds received under ULIP. Okay. Now, what the circular provides? Provides that first situation. So the first situation, it provides that in a case where that the amount is in a case where the sum including the bonus is received on any ULIPs. The sum is received on any ULIPs. how do we determine the exemption? How do we determine the exemption? So that is what the guidelines provided. Situation 1, where during the year, no consideration is received. No consideration is received on the ULIP during any previous year preceding the current year. Like before this year, you have not received any consideration, or even if you have received any consideration on the ULIP, but that has not been claimed exempt. Now, how would you determine the exemption? Now, let's say if the assessee has received the consideration during the previous year under the ULIP and the premium does not exceed 2,50,000, and the premium does not exceed 2,50,000, then there will be exemption under 1010D. If the premium is not exceeding, then there will be obviously the exemption under section 1010D. If the assessee has received the consideration under the ULIP and the premium payable on such ULIP exceeds rupees 2,50,000 for any of the previous years during the term of the ULIP, then exemption under 1010D will not be applicable, right? So if my premium is greater than rupees 2.5 lakh, then no exemption under section 1010D. If it is less, then exemption under section 1010D. Right? Now, if the assessee has received the consideration under, let's say, more than one ULIP. If there are more than one ULIPs in the year, but the aggregate premium also does not exceed 2,50,000, then still there will be exemption under 1010D. Even if the consideration is received for one ULIP, but the aggregate premium is not exceeding 2,50,000, then there will be still exemption. So even if there is one ULIP or there are multiple ULIPs, the aggregate consideration should not exceed 2,50,000. If the aggregate exceeds 2,50,000, then the consideration will be not eligible for 1010D. Are we clear? Are we clear? Now, understand one thing. Let's take an example to understand this. So, example is, let's say the date of issue is 1/4/21. Premium annually is 2,50,000. Sum assured ₹25 lakhs. Consideration received as on 1/11/2031 is 32 lakhs. Now, the assessee has not received any other consideration. Whether there will be exemption or not, what do you think? Here also you need to understand one thing. Premium exceeds 2,50,000 plus I've not written here the additional condition. What is the additional condition here? The additional condition is that the premium paid should not exceed 10% of the sum assured. Premium, if it's greater than 10% of capital sum assured. So whether here there will be exemption in this example or not. Yes, allowed. So here the exemption will be allowed for the reason that if you see the consideration received here will be allowed as exempt because the annual premium does not exceed 2,50,000 and also does not exceed 10% of the capital sum assured. So exemption in this case under 1010D allowed because this is less than 2.5 lakh. Then this is also less than 10% of sum assured. Right? Example 2. Date of issue, or let me write it here only. This is example 1. Example 2. One 421. Annual premium 5 lakhs. Sum assured 50 lakhs. Consideration received as on 1/11/31 on maturity 60 lakhs. So whether the exemption will be available. Yes, Dilip, you are correct. Nikhil, yes, correct. So Nikhil, you have answered. Okay, you have answered for the example 2. No, example 2, Nikhil, no exemption will be allowed over here. Why? Because this is exceeding rupees 2.5 lakh. So exemption not allowed. Because this is exceeding 2.5 lakh, so therefore the exemption would not be allowed since the premium payable exceeds rupees 2.5 lakh. Clear? Example 3. Date of issue 1/4/21. Annual premium 1 lakh. Sum assured 10 lakhs. Consideration received 12 lakhs. In this case, whether there would be exemption or not. Also, let's make it like this. In example 3, we have two ULIPs, A and B. In example 3, we have two ULIPs, A and B, 1, 4, 21, 1.5 lakh for B, sum assured 15 lakhs, and amount received 18 lakhs. So there are two ULIPs which are taken in example B. Now, what will be your answer? Yes, Nikhil, you're correct. It is allowed because the aggregate premium is not exceeding rupees 2.5 lakh, plus it is less than 10% of the sum assured. Right? So in this case, in example 3, the exemption will be allowed. Right? Example 4. We have 3 ULIPs taken during the year. Date of issue is 1/4/21, 1/4/21, 1/4/21. Annual premium is 1 lakh, 1.5 lakhs, and 3 lakhs. Sum assured is 10 lakhs, 15 lakh, and 30 lakh. Consideration received is 12 lakh, 18 lakhs, and 34 lakhs. Whether in this case, the exemption will be available or not. Yes, Dilip, you were correct. Raja, very good. Yes, Nikhil, very good. Okay. So here in this case, the aggregate premium is exceeding the 2,50,000 limit. That is very clear. Now, what does the circular provide that? The circular clarifies that if the aggregate premium exceeds 2,50,000 for any of the previous year, consideration in respect of any of the eligible ULIPs whose aggregate amount does not exceed 2,50,000 would be eligible for exemption. provided that their annual premium is less than 10% of the capital sum assured. So in this case, the aggregate premium is exceeding 2,50,000, but for A, what is the aggregate premium? For A, the aggregate premium, is it exceeding 1 lakh? The answer is no. The aggregate premium in totality, if you see, it's exceeding 2.5 lakh. But this premium is less than 2.5 lakh for A, and this is less than 10% of the sum assured. So for A, the exemption under section 1010D is available, since the premium less than 2.5 lakh plus less than 10% of 10 lakhs, right? For B also, it will be available, right? Because the premium is less than 2.5 lakh, same reason. For C, this will be taxable. Did you understand this? Dilip, did you understand this? So, yes, Ankur, you are correct. In A and B, it is allowed, but on policy C, not allowed. Very good. Are we clear? So, this is what is explained by the circular. The consideration received under B and A will be exempt. It is only for the C which will be taxable. C will not be exempt since the aggregate for A, B, C exceeds 2,50,000. However, the consideration received under A and B shall be exempt since the aggregate of both of these policies do not exceed 2,50,000. Are we clear? Clear? Next example. Example number 5. Let's take XABC. Date of issue for X is 1/4/20. This is 1/4/21. This is 1/4/21. And this is also 1/4/21. Annual premium 2.5 lakhs, 1 lakh, 1.5 lakh, and 3 lakh. Sum assured 25 lakhs, 10 lakhs, 15 lakhs, and 30 lakhs. Now, consideration received for X as on 1/11/2030 is 30 lakhs. As on 1/11/31, the consideration received is 12 lakhs for A, 18 lakhs for B, and 34 lakhs for C. Now, what would happen in this situation? Here, the consideration which is received is, if you see, different year. For X, it's received in a different year, and for ABC, it's received in a different year. Also, keep a note of the point that this 2,50,000 limit is applicable from 1st February 21. So in this case, for the X, the 2,50,000 limit will not be applicable. So for the X, even if the premium would have been 3 lakh, 2 lakh 50 limit would not have been applicable. The only consideration or the only condition which is there for X is that the annual premium should not exceed 10% of the sum assured. So in this case, limit of 2.5 lakh is not applicable. 2.5 lakh limit is not applicable as policy issued before 1/2/21. Plus the premium is less than 10% of 25 lakh sum assured. Therefore, for X, 1010D is available. Right? Now, what about A, B, and C? What about A, B, and C? Yes, Raja, very good. Yes, Nikhil, correct. Yes, Dilip, correct. Very good. All of you have understood very well. So A, B, and C, out of these two, A and B will be exempt. C will be taxable. As your premium is lesser than 2.5 lakh, plus it does not exceed 10% of the capital sum assured, right? Plus it does not exceed, plus less than 10% of sum assured, right? Now example 6. Let's say there are two ULIPs, X and A. Date of issue 1/4/21 and 1/4/22. Premium is 2,50,000. Sum assured is 20 lakh and 5 lakh. Consideration received on maturity. This is received on 1/11/2031, 25 lakhs. And this is received on 1/11/2032, 6 lakh. So in this case, what will be the exemption? Yes, Dilip, you are correct. Both are exempt. Since, so 1010D exemption available for both as premium less than 2.5 lakh plus less than 10% of sum assured. Okay. Next example. Example number 7. Let's say again I have two policies, X and A. Date of issue is 1/4/21 and 1/4/22. Premium is 2 lakh and 1 lakh. Sum assured is 20 lakhs and 10 lakhs. Consideration received is 25 lakhs and 12 lakhs. Now, whether the exemption will be available. Whether the exemption will be available. Exemption, yes, the leap is only available to X. No, Nikhil, it is available only to X, not either X or A. No, Raja, X or A, no. We can take X is more beneficial. No, here it is only available to X. So here, since this is less than 2.5 lakh premium plus less than 10% of sum assured, so this is exempt. This, if the aggregate premium is exceeding 2.5 lakh, even if it is in the different years. So the CBDT circular provides that the consideration received will not be exempt under 1010D. What does it provide? It provides that if the aggregate amount on the ULIP and the old ULIP exceeds 2,50,000, then consideration would not be eligible for exemption under 1010D. So this is taxable since aggregate amount of premium of new plus old ULIP exceeds rupees 2.5 lakh. Are we clear? Example 8. Example 8. Now, here, let's assume in the example 8, let's assume we have 4 ULIPs. X, A, B, and C. This is on 1/4/21. This is 1/4/22. This is 1/4/22 again. And 1/4/22. Now, how this example 8 is different from example 5? Let's try and understand, okay? Premium is 2 lakh, 1 lakh, 1.5 lakh, and 3 lakh. Okay. My sum assured is 20 lakhs, 10 lakhs, 15 lakh, and 30 lakh. This I have received 25 lakh in 31, and this I have received in 32, 12 lakh, 18 lakh, and 34 lakh. Now, if you see the example 5, which is there, it is more or less similar to example number 8. The only difference is that X year is issued after 1st April 21, and here in example 5, it was issued on 1/4/2020. So for X, 2.5 lakh limit was not applicable as it was issued prior to 1/4/2020. But if it would have been issued in 2021, then the example is exactly going to be the same, right? So then in that case, you will consider it in the similar way as example 8 only. Are we clear? So what will be the answer over here? Yes, Nikhil, even though the maturity is in different financial year, but what the circular provides is that if it is consolidated, you have to see the old one as well as the new one. What about this one? Okay, let's try and understand in this situation because this is very different. For X, there will be exemption, right? X, there is a clear-cut exemption because this is less than rupees 2.5 lakh. My premium is less than 2.5 lakh plus less than 10% of 20 lakhs, right? Now, for A, B, C, if you see the aggregate premium of the old ULIP plus the new ULIP exceeds rupees 2.5 lakhs, right? Exceeds rupees 2.5 lakh. Now, what the CBDT circular provides is that you have an option. You have an option. What option do you have? Now, if this exceeds 2.5 lakh, all of these three will be taxable. That is your alternative 1. What is alternative 2? Alternative 2 is you tax this 25 lakhs, this you take it as taxable in 2031, and you take these two as exempt. This is your alternative 2. So exempt A and B, which is 30 lakhs almost. Tax X, which is 25 lakh. Why exempt A and B? Since the premium aggregate premium is less than rupees 2.5 lakh and less than 10% of sum assured. So in case you want, you can exempt these two and tax X and tax C. C any which ways will be taxable, right? But in case you want, you can exempt X. In case you want, you exempt A and B. This is what the CBDT circular provides for the alternative treatment. It says that in case if the amount on the old and the new ULIP exceeds 2,50,000, then A, B, C will not be exempt, right? However, in case you want, you can exempt A and B and tax X. Are we clear? Are we clear? This is the alternative treatment which has been suggested. Right? But see what happens generally, practically, what will happen is that you may not be aware as to in the year 1, what will be the amount in year 2 which would be received. Or you may be aware because what happens is that the premium and the considerations are already decided. So you may be aware and you may choose it accordingly. Are we clear? Next example, example 9. Example 9. Date of issue, let's say I have X, A, B, and C. Right? X, A, B, and C. And let's say I have one more, Y also. Let's say I have Y also. So now 1, 4, 21, 1, 4, 21, 1, 4, 22, 1, 4, 22, and 1, 4, 22. This is going to be 1 lakh, 1 lakh, 1 lakh, 1.5 lakh, and 3 lakh. Sum assured is 10 lakhs, 10 lakh, 10 lakhs, 15 and 30 lakhs. Consideration received as on, let's say 1st July 25. I'll add here one more. Consideration received on 1/7/25. It's, let's say, 6 lakh. This is, let's say, 12 lakh. And then rest are received 12 lakh, 18 lakh and 34 lakh. Now you have to tell me what will be the answer here. Yes. X, Y, A. Y and B. Okay. Question for X does not arise. Yes. Okay. Let's try and understand. All of your answers may be correct. Let's try and understand. So, X is any which ways exempt as consideration less, sorry, as premium less than 2.5 lakh plus less than 10% of sum assured, right? Y will also be exempt, right? Because here also the aggregate premium is less than 2.5 lakh, right? So these two will be exempt very clearly. Now, if you see all these, therefore this premium exceeds 2.5 lakh. So very clearly, these three will be taxable. These three will become taxable. This is alternative 1. Alternative 2 is X taxable. So then Y will be exempt with either A, or you can claim Y exempt with B. This is alternative 2. Alternative 3 is X taxable, Y taxable, A and B exempt. Because their premium does not exceed 2.5 lakh. Now, if you see the consideration, X is for how much? 6 lakh. Either you claim 6 lakh as exempt, 12 lakh as exempt, and this particular amount. This is any which way is taxable. So 12 plus 18, you tax it, which is in fact a loss. So I take 6 as taxable. Then I may choose to exempt 24 lakhs or 12 plus 18, 30 lakhs. So 12 plus 18, 30 lakh is more beneficial. Or I choose to tax these two and exempt these two. So it's up to you. How do you wish to claim? Whichever is beneficial, you can claim that. Are we clear? Are we clear? Any doubt? Any questions? Okay. Any questions? Any doubt? Yes, Ankur. Are we clear with this? Did you understand? Okay, perfect. So ULIP is clear? Yes, Dilip. Correct. Whichever is beneficial, that you can take it up. Shall we proceed further? Okay. Let's proceed further. Now ATC is clear. We move on to the next one. We move on to the next deduction, which is in respect of, after ATC, we move to the other deductions, okay, which is in the context of ATCC, right? ATCCC. So ATCCC, which is deduction in respect of contribution to the pension funds. This is contribution to the pension funds. This is for the individual. For the individual who has deposited the sum for any annuity plan of LIC. Which is the pension plan of LIC. Then for receiving the pension from the fund setter, then he shall be allowed a reduction in the computation of the income. Okay, are you clear? So annuity plan of LIC, any contribution made, that is allowed as deduction. The max deduction is 1.5 lakh together with the ATC. This is not over and above ATC, together with ATC. Because there is an overall cap under ATCCE. Now, if any amount which is there in the fund, which has been allowed as deduction, right? Interest will not be allowed as deduction. Interest credited is not allowed as deduction, right? So any amount which has been allowed as the deduction, if it is received by the assessee, if he surrenders the policy, right, then that will be the income of the assessee, right? So any withdrawal will be deemed income. Similarly, pension received is also the income. Pension received is also the income, right? Then next is ATCCD. This is the NPS scheme, National Pension Scheme. Now, what is National Pension Scheme? So deduction is allowed in respect of contribution made to the pension scheme of the government, which is Atal Pension Yojana, which is a notified scheme. Now, what is the deduction over here? The deduction over here is 10% of the salary. right? 10% of the salary is allowed as deduction. 10% of the salary is allowed as the deduction. So, employee of the, this is allowed to the employee of the central government or the state government. 10% of the salary is allowed as the deduction, right? Then, by any other individual who is not an employee, a self-employed person is allowed 20% of salary. Because for the employee, the 10% is allowed. This is, you can write it over here, not just NPS, but we can put it over here. Pension fund, pension scheme of government. So employee is allowed a deduction for the amount paid or deposited by the employee. This is employee's contribution, which is 10% of the salary is allowed. This is the employee contribution. Central government, state government, or any employer. Are we clear? Now, what about the employee's contribution? The employer's contribution is also allowed as the deduction. So this is the employee contribution plus the employer contribution is also allowed under 80 CCD 2. Contribution made by the central government or by the state government is allowed under 80 CCD 2. But that would be restricted to 14% of the salary. So employer contribution for the central government or state government employer is 14% of salary. For any other employer, it is 10% of salary. Are we clear? So 80 CCD, I'm making one chart for you. Contribution to pension scheme, employer contribution, central government or state government, 14% of salary, other 10%. Employee contribution, this is always 10% of salary. Other individual, 20% of gross total income. This is not, sorry, salary, this is total income. He is not an employee, right? 20% of gross total income. Are we clear? So this is under 80 CCD 2 and this is under 80 CCD 1. Right? Now the deduction under 80 CCD 1 is subject to 1.5 lakh overall deduction. So this is subject to 80 CCE 1.5 lakh deduction. Whereas under 80 CCD 2, the employer contribution which is provided, right? The employer contribution which is provided, that is not subject to the overall limit of 1.5 lakh. So that is in addition to 1.5 lakh. So 80CCE does not apply, is not applicable over here. So no cap of rupees 1.5 lakh. Plus under 80CCD 1B, NPS contribution rupees 50,000 is allowed. Again, this is not subject to 80CCE. So 1.5 lakh cap not applicable. Are we clear? Right? So 80CCD has the employer contribution of 14% for central state government, 10% for any other employer. Then salary here means salary plus dearness allowance. Salary means basic plus DA. For the employee contribution, it is 10%. In case of other individual, it is 20% of GTI. And for NPS, 50,000 is extra allowed. Clear? 80CCD2 is not subject to 1.5 lakh, but 1, which is the employee contribution, is subjected to 1.5 lakh. Are we clear? Now the amount which is deposited under the pension scheme will be taxed on the closure of the account. So withdrawals on the closure of the account, opting out of scheme, then in case the pension is received, these amounts will be taxable. These amount will be taxable. So exemption will not be available. Sorry, the deduction which is allowed earlier will be taxed if the amounts are received on the closure on account of the opting out of the said scheme. However, on the death, if the amounts are received, in all these three cases, pension received on death or the withdrawals on death, not taxable. So this is taxable and this is not taxable. Okay. Are we clear? Even in case of the NPS trust, when the payment is made from, when the withdrawals are made from the NPS trust on closure of the account or on the opting out of the pension scheme, any payment from the NPS to the assessee on account of the closure or on account of his opting out of his scheme is taxable. However, there is section 1012A. There is section 1012A for the NPS. For the NPS withdrawal, on closure, 1012A provides that any withdrawal from the National Pension Scheme on the closure or on opting out to the extent of 60% of the amount withdrawn shall be exempt. So 60% will be exempt. 40% is taxable. 40% is taxable. 40% in that case is taxable. Are we clear? So in case the withdrawals are made, from the NPS account, then in that particular case, the 60% of the amount which is there, that will be exempt, but 40% will be considered as taxable under 10(12)(a). Are we clear? In case of the pension fund, sorry, 60% is taxable and 40% is exempt. Sorry, just change this. Okay. Are we clear? So any amount which is received on the closure of the account or on the opting out of the scheme, except if it is case of the death, then it is taxable for the pension fund. And if it is receipt of the pension, that is also taxable, except otherwise on the death. Now, in case of the NPS, as I said, 10(12)(a) clearly provides that any amount received from the NPS to the assessee on account of closure or on account of opting out of the pension scheme, to the extent it does not exceed 60% of the amount. To the extent it does not exceed 60% of the amount, that shall be exempt from tax. In case of the partial withdrawal, there is not closing or opting out, but there is partial withdrawal. If there is partial withdrawal, then if the employee takes the partial withdrawal from NPS, not exceeding 25% of his contribution, then that amount will be exempt. So this partial withdrawal for the employee, only for the employee, if less than 25% of contribution, then that is exempt. Otherwise, for other than that, this is taxable. Are we clear? Any doubt? 10(12)(a) for the employee, it will be salary. For any other person, it will be income from other sources. Delete. Okay. What is opting out of the scheme? That I would not want to continue with the NPS scheme. Clear, Viraj? So in NPS or the pension scheme, not just NPS, let's say there are certain organizations which make you opt for the pension scheme. It's a voluntary scheme. If you go with the organization's pension scheme, wherever you are employed, and then you say that I do not wish to continue with that, in that case, you're opting out of that scheme. Clear, Viraj? Okay, so 80CCD is clear, right? Now, as I said, 80CCD1, 80CCD2, and 80CCD1D, right? 80CCD1B, which is for the pension, national pension scheme, which is in excess of 1,50,000. Now, under 80CCE, as I said, you have the limit on 80C, 80CC. So here also you have 80CCE. So 80CCE overall limit will cover 80C plus 80CCC plus 80CCD1. This is all subject to 1.5 lakh limit. Are we clear? So 1,50,000 will not cover NPS and the employer contribution to the pension scheme. Clear? Are we clear? Okay. Then next is 80D. 80D is in respect of an individual. In respect of the individual, again, what is the deduction which is allowed? Premium paid for the health insurance. This is for the health insurance. Who is covered over here? Self, spouse and dependent children. So deduction is allowed for the health insurance premium paid, right? And what is the deduction which is allowed? The deduction is allowed of 25,000. 25,000 is allowed that as the deduction, right? Plus, if it is for the health insurance of parents, then another 25,000 is allowed. Another 25,000 is allowed, right? An increased deduction of 50,000 will be allowed in case either you, your spouse, or your children, or your parents. Children will not be, of course, when you are yourself over 50, sorry, a senior citizen. Then, in case of the senior citizen, 50,000 rupees is allowed. 50,000 is allowed. Now, who is a senior citizen? Resident. Mark this word. Resident and not a non-resident. Resident individual greater than 60 years. Right? Greater than equal to 60 years. A non-resident senior citizen will not get 50,000 deduction. Okay? Also here, deduction is allowed not just for health insurance, but preventive health checkup. Preventive health checkup of up to rupees 5,000. Now this is allowed on the preventive health checkup of spouse, children, dependent, or the parents. However, this is within the overall limit, of 25,000 or 50,000 as the case may be. Clear? Now the payment here can be by any mode, including cash, in respect of any sum paid on account of preventive health checkup. So preventive health checkup can be in cash or check. But the health insurance has to be by other than cash. Health insurance has to be by other than cash. Are we clear? Further, deduction is allowed for the medical expense of senior citizen. Medical expense of senior citizen who are aged more than 60 years and who are resident in India. A deduction of 50,000 rupees will be allowed on account of the medical expenditure if there is no insurance from them. In case of the HUF, for the HUF, the deduction is allowed for the health of the family member, any family member. What is the amount? Would be 25,000 or 50,000 for a senior citizen. Are we clear? Further, for the HUF also, again, the medical expense is allowed for 50,000 for a senior citizen. Right? Medical expenditure is allowed for the senior citizen. Right? So as I said, premium has to be paid by other than cash. Premium has to be paid by other than cash. So what is under ATD allowed? Any premium paid otherwise than in cash for the health insurance, for the self, spouse, dependent children. In ATC, the LIC was for self, spouse, and children, dependent or independent. But for health insurance, it is self, spouse, and dependent children. And under ATD, you have the coverage of the dependent parents also. You have the coverage of the dependent parents also, whereas under the ATC, you did not have the coverage of the parents. You did not have the coverage of the parents, right? There was individual spouse or any child, dependent or independent child, anyone. Here you have the premium for self, spouse, dependent children, and the parents, whether dependent or not. Under ATD. You can have for the senior citizen 50,000, otherwise it is 25,000. And you can have the preventive health checkup payment, which is 5,000, but that is within the overall limit of 25 or 50,000. And in case any person is senior citizen, it goes to 50,000. For the parents, there is additional amount of 25,000 or 50,000 if they are senior citizen. So there could be the overall deduction of 50,000 in case nobody is senior citizen. And if you're covering your parents, if you as well as your parents are senior citizen, then it goes to even 1 lakh. Clear? Are we clear? And for preventive health checkup, it's maximum 5,000. For senior citizen parents, medical expenditure of 50,000 is also allowed. Now, in case of the family members where they are senior citizen, the aggregate of deduction in respect of premium as well as the medical expenditure cannot exceed 50,000. So you cannot have like 1 lakh deduction for premium as well as the medical expenditure. Only the limit is 50,000. Whether you pay premium or you pay medical expenditure. Are we clear? Even if your one parent is covered by medical premium, another is not. So then the aggregate amount will be 50,000, which will be allowed to you. Whether you are paying for the medical expenditure for one parent and for premium of another parent. Clear? Are we clear? Any doubt? Okay. Next is 80DD. 80DD, which is deduction for the maintenance of maintenance, including medical treatment of dependent disabled. Now, this is for individual as well as HUF. Individual or HUF. Any amount for the medical treatment, training, rehab of a dependent with who's a disabled person, right, qualifies for the deduction. Now, what is the quantum of deduction? Including the medical treatment amount, this is 75,000. In case of severe disability, this goes to 1.25 lakhs. 1,25,000. However, you cannot have deduction claim like this only. You need to furnish a copy of the certificate for the persons with the disability. So then only this will be allowed. Now, who is a dependent? Spouse, children, parents, brother or sister, who is wholly or mainly dependent on the individual. So spouse, dependent is spouse, children, parents, or siblings. but they should not have claimed any deduction under ATU. Are we clear? So this amount is for the medical treatment for the disabled. Clear? And in case that dependent disabled dies before the person who has taken any scheme for this person, right? There is also a scheme available where you can deposit of LIC. So then the amount will be taxable in the hands of that particular person. Then the amount will be taxable in the hands of that particular person. Are we clear? Any doubt? So that will be deemed income of that particular person. Any question, any doubt? Now there is an amendment over here. What is the amendment is that what are the qualifying amount? As I said, the qualifying amount is not just the medical treatment expense, but any amount paid to the LIC for this person. Now the scheme should provide for the payment of lump sum amount or annuities for the benefit of dependent person who is disabled. In the event of the death of the individual in whose name the subscription was made, or on attaining the 60 years or more by such individual for whom the deposit was made, right? Now, the benefit of deduction is also available to assessee incurring the expenditure on the maintenance of these particular person. Now, as I said, if the dependent person who was disabled, he dies before the individual in whose name subscription was made, then the amount which is deposited would be chargeable in the hands of the person in which the amount is received by him, in the year in which amount is received by him. However, this will not apply. The income will not be deemed to be of the person in case even if the disabled person dies. If the amount received by the dependent before his death or attaining the 60 years age. So if the amount is received by that person only for whom the amount was deposited, then there would not be any income taxable. But if he dies before the income is received by him, if he dies and the other person receives the income, then it will be taxable in his hands. Clear? Are we clear? So that is ATDD. Next is ATDDB. Next is ATDDB. What is ATDDB? This is for the medical treatment. Deduction for medical treatment. Now, this is available to an individual or HUF resident in India. Individual or HUF who is resident in India for the medical expenditure on himself, for self, or dependent. Now, who is a dependent over here? Again, it is spouse, children, parents, or siblings. Right? Who are wholly or mainly dependent, and same is for the member of HUF. Now, what is the qualifying amount? The amount paid for the medical treatment of the specified diseases, which is 40K or 1 lakh for senior citizen. The definition of senior citizen remains same, 60 years or more, and who is a resident individual. Are we clear? And if any amount is received from the insurance, then that amount will be reduced. Clear? Any doubt? Any question? Any doubt? Okay. So shall we take a small break and then we are left with few deductions, few small deduction, and then we'll move towards the deduction on the category of the income. Clear? Let's take a small break of 10 minutes. Yeah. Okay, students, any questions? Severe disability, they have specified, Viraj, like what are the severe disability, what are disability, they have specified. Geeta, for the HUF will get 25,000 for the members, for all the members. Overall 25,000 deduction, yes, or 50,000. Overall will be limited to 25, not per member. ATD overall will be limited to 25,000 even in case of individual or even in case of the HUF. That is very clear. Are we clear? Whether ATD is available to NR? Yes, it is available. So what does it say is ATD which provides that in case of the individual, the deduction is allowed to the individual, whether R or whether NR. It doesn't say that individual should be a resident individual. Clear? Any other question? It says just the individual. Clear the leap? Expenses, preventive health checkup, whatever health checkup expense you pay. Both spouse and parent greater than 60, then maximum would be 1 lakh. Yes, Kaushik. Okay. Yes, let's move forward then. So now we have done ATDDB. Now next deduction is in respect of the interest-based deduction, which is first is ATE. ATE is interest for higher education, interest on loan for higher education. What is the amount? This is available to the individual. Then the loan must be taken for the higher education or the higher education of relative. So self or relative education. Are we clear? What is higher education? It means any course of study after 12th. After the 12th, right? So interest on loan after 12th for pursuing any course after 12th. After class 12. Okay. Relative here means spouse or children. Spouse or children. Clear? What is the deduction which is allowed? The interest on the loan. For the 8 assessment years, it is allowed. 8 AYs, it is allowed proportionately. Okay? 8 AYs which is allowed proportionately. Clear? Then next is in respect of ATEE. What is ATEE for? ATEE is for interest on loan borrowed for the house property. Interest on loan borrowed for the house property. But this is for the loan sanctioned during previous year 16-17. So ATEE is not any more relevant because this is, as I said, for the loan sanctioned during the previous year 16-17. So this was a limited scheme which had come up during that point in time. And if the loan was sanctioned during 16-17, house was less than 35 lakhs, and the loan was less than 35 lakhs, value of the house was less than 50 lakhs, then the deduction of the interest was allowed. It is not any more relevant because this was for the loan sanctioned during that period. Then next is the interest on loan taken for the residential house property, where the loan was sanctioned between 2019 and 2022, where the stamp duty value of house was less than 45 lakhs. Then there is a deduction available under ATEEA, where the maximum deduction is 1,50,000. 1,50,000, but the loan should have been before 31st March 2022. So then this deduction is allowed up to 1,50,000, which is over and above deduction under 24B for the interest deduction while computing the income from house property. So interest deduction for the self-occupied property, if you know, it is restricted to 2 lakh. In case of let out or DLOP deemed to be let out, even there is no limit. But Section 71, which is set off and carry forward of losses in respect of house property, restricts the set off of the loss with respect to the other income only up to rupees 2 lakh. Now, in case of this eligible property, the deduction can be claimed under 80EE. The excess amount can be claimed under 80EE. Are we clear? Then this is the new one which has been there. 80EEA. So 80EEB. So why I'm not writing 80EE also, because this was also for the loan sanctioned prior to 31st March 22. Now this is for the electric vehicle, loan for the electric vehicle, interest on loan for electric vehicle, EV. This is for the individual, available to the individual. Now the loan should be sanctioned between (1/4/19) to 31st March 23. If you purchase the electric vehicle, the benefit of the deduction is up to rupees 1.5 lakh. The maximum deduction is under up to rupees 1.5 lakh for the purchase of the electric vehicle. Next is 80G, your favorite section, which is for the donations. 80G is for the donation, where the assessee pays the sum to the eligible funds or institutions, then he is entitled for the deduction under 80G. Now, under 80G, there are certain deductions which apply for 100% deduction. There are certain donations which apply for 100% deduction, which is in respect of the Prime Minister National Relief Fund, Prime Minister Earthquake Relief Fund, National Defense Fund set up by the central government, or approved funds which are there, which are approved only for 100% deduction, right? Which are mostly established by the central government, right? For example, Clean Ganga Fund set up by the central government, Swachh Bharat Kosh, which is set up by the central government, right? So the Prime Minister funds or the central government funds are eligible usually for 100%. Then there are certain donations which qualify for 50% deduction, which is Jawaharlal Nehru Fund, Prime Minister's Drought Relief Fund, Indira Gandhi, Rajiv Gandhi Trust Fund. All of these qualify for 50% deductions. There are certain deductions which are qualifying for 50%, but with the limit subscribed to it, which is paid to any institution or fund established for charitable purposes, for family planning, for any corporation which is established by the central government, for repairs to any temple. There, the limited amount of donation is that the donations which are eligible should be limited. 50% of the donation is allowed, but this is subject to the limit of 10% of the adjusted GTI. This is restricted to the 10% of the adjusted GTI. This would be the maximum permissible deduction. Are we clear? So what you have to do is you have to first compute the total income after allowing all the deductions except under 80G, right? And you will not include their short-term capital gain under 111A because Chapter 6A deductions are not allowed. Long-term capital gain under 112 and 112A because there also the Chapter 6A deductions are not allowed. And you will exclude the income which are taxable at special rates under 115A, AB, all of that. So you will compute the gross total income excluding that but allowing the other deductions. You would calculate 10% of the adjusted total income, calculate the actual donation which is subject to the qualifying limit, which is 10% of the adjusted GTI. Now lower off adjusted 10% of the GTI or the actual donation is the maximum permissible donation, and 50% of that will qualify for the deduction. Are we clear? 50% of that will qualify for the deduction. Clear? So this is if it is paid to any funds, which is like charitable trust or any other institution, to that the 50% limit will be applicable. Clear? Any doubt till now? But the funds should be, the funds which are established should be the charitable trust, and the institution of funds should derive the income which is exempt under 1023C or under section 11, and they should have maintain the particular details of the donation received. They should issue the donation receipts to the donors, and these funds should be approved by the principal commissioner or CIT. Also, they should file the requisite forms for the donations which they are receiving, file the statement of the donation received. So at present, there was no reporting which was there by these entities receiving the donation. But there has been amendment which has been made, through which the institutions of funds now have to prepare the statement of the donation received and furnish it to the income tax department. They also need to furnish a certificate to the donor in respect of the donations which they have paid. Are we clear? In respect of donations paid in cash, 2,000 rupees is only up to allowed. So no deduction will be allowed in respect of any donation exceeding rupees 2,000 if it is paid in cash. Clear? Any doubt? Any questions? Any doubt? Any questions? So there are the conditions which are even imposed on the institutions which are receiving the donation, that they have to maintain the proper records and furnish the statements for that. Clear? Any questions? Okay. Yes. Perfect. Next is after ATG, the next deduction which is there now is in respect of ATGG, the last deduction. ATGG. Here you can write 50% or 100% or 50% with limit of 10% of adjusted GTI funds or charitable trust or institutions. Claiming exemption under section 11 or 12 or 1023C. Right? What is adjusted GTI? Gross total income less deductions, excluding income chargeable at special rates. Right? Okay. Now ATGG is in respect of the rent paid. Deduction in respect of the rent paid. Now this is for the assessee who is not receiving HRA, meaning he may not be the employee, who is not in receipt of the HRA and who pays rent for the accommodation. So the assessee should not be receiving any HRA which is claimed exempt under 1013A. The expenditure is incurred by him on the rent of any unfurnished, furnished accommodation, which should not exceed 10% of his total income. So then in that case, the accommodation should be occupied by him for his own residence, and here the condition is that the assessee or his spouse or minor child or the HUF of which he is member should not own any accommodation, should not own any accommodation at the place where he ordinarily resides, or works as employee or carries on his business or profession. If the assessee owns any accommodation at any place which is not near to his house or near to his workplace, such accommodation should not be in the occupation of the assessee, and the annual value is not chargeable under 23. Under 23. So what does it say is that the assessee should not own any accommodation which is near to the house where he is at the moment staying on rent or near to the place of the work. Even if he owns one accommodation, even if he owns an accommodation at any place which is not near to his house or place of work, then that particular place should not be occupied by him. Should not be occupied by him. Also, that place should not be considered as a self-occupied property. So that place should not be self-occupied property, meaning the income should not be charged under the IFHP. Then in that particular case, this 80GG will be available as the deduction. 80GG will be available as the deduction. Okay. So, occupied by him or is treated as self-occupied property. Okay. Then what is the deduction quantum which is available? Deduction is lower of actual rent paid minus 10% of total income. Before allowing this deduction, 25% of total income and 5,000 per month. So lower of these amount will be allowed under 80GG. Now in HRA, you can have the house property which is there in the same city, but here it is not the case. Here under 80GG there is condition. Under 1013A for HRA there is no such condition that you should not have any other house property in the same city. But here there is this condition. Okay. Next one is 80GGA, which is deduction for the donation for scientific research. Donation for scientific research. So any amount paid in respect of the donations made for scientific research or rural development where the assessee does not have income under the head PGBP. If you have income under the head PGBP, you have deduction under 35. But if you do not have income under the head PGBP, you can still claim the deduction if you are an employee or something. You're paying to any research association or any university, college, or in respect of, any scientific research program, or in case of any scientific research you are paying to any committees, then in that case, the deduction is available for the payment of the sum paid to any institutions or any research committee. Okay. So that is the deduction which is allowed. No sum cash donations up to rupees 2000. You can write the same point even for ATG. Cash donations up to rupees 2000, even under ATG. Okay. Any doubt? Okay. Then ATGGB, which is political parties. Contribution by companies to political parties. So if you remember, we used to disallow the expense for the political parties under section 37, but you can claim the deduction under ATGGB. Are we clear? So you can claim the deduction under ATGGB, but no amount allowed for cash deduction. No deduction for cash contribution. Are we clear? Okay. Then this is by companies. ATGGC is by any person other than the companies. Again, to the political parties, everything rest remains the same. ATU is for the disability. ATU is for the disability. If a person has a disability, he can claim the deduction under ATU. ATU is for the disability. What is the deduction? The deduction is here 75,000 rupees or 1.25 lakh for severe disability. 75,000 or 1,25,000. This is for the, again, resident individual. Resident individual. Okay. Are we clear? Yes, 100% is deduction is allowed for Olympic family planning, but that is restricted to the 10% of the GTI, Geeta. Okay. Now we move towards the deduction in respect of the income. So deduction in respect of income. Now understand, this is very, very important, and this is where most of the questions come. So if you remember, we have done investment based deduction under 35 AD as well, right? If you remember, we have done that under 35 AD also. Now 35 AD was under PGBP with respect to the deductions which are there with respect to the investment which is made, right? Now in case, you can also claim it, the deductions under chapter 6A for the profit linked deduction. So one second, got changed. Okay. Yes. So we have section ATIA, ATIB or ATIAB. We have section ATIAC. Then we have section ATIB. And we also have 10AA deduction. Though it's an exemption under 10, but it is more or less like a deduction. Now, first is ATIA. ATIA provides a 10-year tax holiday to an assessee whose gross total income includes the profits and gains from the developing, operating and maintaining any infrastructure facility. So, ATIA which is there is available to, I can write it here, eligible person is the assessee carrying on business of developing or maintaining infra facility. That is ATIA. Now this is, as I said, is in respect of developing or operating and maintaining or developing any infrastructure facility, right? Industrial parks, power undertakings, all of these are eligible for ATIA and ATIA-B. Industrial parks are also there. Then power undertakings are there. Then for that matter, undertaking which is for the reconstruction or revival of a power generating plant. All of these businesses are covered under ATIA. Now, what is the quantum of the deduction which is available over here? What is the quantum of the deduction? So, the deduction which is available under here is, in respect of ATIA, it is 100%. It is 100%. It is 100%. Quantum of deduction is quantum of deduction is 100% of profit derived from the eligible business. It is 100% of the profit derived from the eligible business. And then there are additional conditions attached to it as to what is infrastructure facility, what are the industrial parks, what are the conditions for that, then what are the power generating units condition. All of that is given under the particular section. But the amount of deduction is 100%, and this is available for the period 10 years from the commencement of the business. 10 AY from the commencement of the business, right? So assessee has to, in case of infrastructure facility, assessee has the option to claim the deduction for 10 consecutive AYs out of the 20 years beginning from the year in which the undertaking develops or begins to operate the eligible business. So 10 AYs out of 20 AYs for the infra business, and for other business, for others, 10 out of 15 AYs. So 10 out of 15 AY beginning from the year in which the undertaking develops or begins to operate the infrastructure facility. Are we clear? So these deductions are allowed under ATIA. Clear? Then next is in case of any amalgamation or demerger, then no deduction will be available to the amalgamating company, but the provisions will apply to the amalgamated or resulting company. So then these provisions will be also applied to the amalgamated or resulting company. Clear? Any doubt till now? This is ATIA. This is ATIA. Any question till now? So this is for the infrastructure facility and power generating units, or the units for the revival of the power generating plants. Any questions? In case this is, as I said, available to the entity which is carrying out this particular business. Okay, clear? Then next is ATIA-B. ATIA-B is available to the SEZ. ATIA-B is available to SEZ. You can write it separately here. 80 IAP is available to the assessee who is a developer who has the income from business of developing SEZ. So your income from developing SEZ. Okay. Again, here the assessee has an option to choose 10 AYs from the 15 AY. 10 out of 15 AYs, the deduction is available. And what is the quantum of the deduction? Again, it is available 100%. It is available 100%. Are we clear? Now, here, understand one thing. There is one important circular which is there, which is for the lease rent from letting out of buildings or space which is developed in the SEZ, whether it is to be treated as business income. Now, the issue is whether the income from the letting out of the premises or developed spaces along with the other amenities in the SEZ is to be charged under PGBP or under the head house property. Why it is important is because if you qualify it wrong, if you qualify it under the IFHP, then you may not get the deduction for that amount. But if you qualify it under the PGBP, then you will be eligible for the deduction of that amount, right? So therefore, it is very important to qualify it in the right manner. So in this particular case, it has been held that, it has been clarified by the CBDT that in case of, there is one decision of the Karnataka High Court wherein it was observed that the government schemes for development of the industrial park, right? In case of that judgment, it was observed that the assessee company was engaged in the business of developing, operating and maintaining the development of industrial parks as per the government scheme and provided infrastructure facility to different companies, and it was the business of this company. So the lease rent which was received from letting out of the developed buildings along with the other amenities would be chargeable as PGBP and not under the head IFHP. And the CBDT has accepted this judgment and it has clarified that in case of undertaking which develops and operates or maintains the industrial park or SEZ notified by the government, the income from letting out of any premises or developed space would be chargeable under the head PGBP and not under the head income from other sources. You can write it down here. So you can write down the circular, CBDT circular, income from leasing of developed space along with amenities chargeable under the head PGBP and not IFHP. Clear? Are we clear? Okay. Next is the deduction under section 80 IAC. Deduction under 80 IAC. IAC. Now this is particularly for 80 IAC is for startup company or LLP. So this is for the startups, whether in the nature of company or LLP. Okay. Engaged in the business of the innovation or scalability, right? Engaged in the business of innovation or the employment scalability model. Okay. So you can write down ATIAC engaged in the development or improvement of products or services or processes or scalable business model with potential of employment generation. With potential of employment generation. Okay. Now, in this particular case, the deduction is allowed to the startups. If you have seen, we have referred to startups at various places under 54 GB also. Here also, there is deduction under 80 IAC. At 54 GB, it was if you sell the house property and invest in a startup, then you will be allowed deduction, right? Now here, what are the conditions? That it should not be formed by splitting up or the reconstruction of a business already in existence, right? So this should not be formed by a discontinued business earlier, or this should not be by a particular business which has been just reconstructed and formed, right? And it should not be transformed by transfer to a new business of machinery or plant which is previously used. Okay, this, so you can write down the conditions over here. ATIAC not formed from reconstructed business not formed with second hand plant and machinery, except, what are the exceptions? If second hand plant and machinery is imported machinery, if it is imported machinery, and secondly, no deduction for that machinery has been claimed in India, and where the value of second hand machinery is less than 20% of, less than equal to 20% of total value of plant and machinery. Are we clear? Then that is only the condition. What is the amount? 100%. 100% deduction is allowed for 3 consecutive AYs out of 10 AYs from the year in which the startup is incorporated. 3 out of 10 AYs from the year in which startup is incorporated. Okay. Now the condition here is that the startup should have been incorporated between 1/4/2016 to 31st March 2022. So there's this condition over here that the startup should have been incorporated between 1st April 2016 and 31st March 2023. Sorry. So the startup should have been incorporated up till 31st March 2023. And the startup's turnover is less than 100 CR. So you can write it down here. Turnover less than equal to rupees 100 CR, for which the deduction is to be claimed. Okay. So the quantum of deduction is 100% of the amount derived. Next one is ATIB. Next one is ATIB. This is in respect of industrial undertakings other than the infra development undertaking, right? So industrial undertakings. Now, what are the businesses which are covered over here under ATIAB? Sorry, under ATIB. IAB we have seen it is for SEZ. This is ATIB. Now, under ATIB, what are the businesses which are covered specifically over here are? So, here under ATIB, we have the industrial undertaking, including the small scale undertakings in Jammu and Kashmir, commercial production of mineral oils or natural gas, processing, preservation, and packaging of fruits, vegetables, meat, and handling and transportation of or storage of food grains. All of these businesses are covered under ATIB. Okay. So here also there are conditions attached to it, and the deduction is 100% available over here. So here also 100% deduction will be available for the initial 5 years, and thereafter 25% deduction is available. So 100% for first 5 years and later 25%. Later 25% deduction is being available. Right? The total deduction which is available here is 100% for the first 5 years, and later on it will be 25%. Clear? Are we clear? Any doubt? Okay. In case of company, it is 30%. For the company, it is 30%. Okay. Next deduction which is available is in case of ATIBA, which is for the housing projects or rental housing projects, but again that was available till 31st March 22, so not relevant as much for your particular attempt. So ATIBA we are not doing it. Then ATIE is there, which is also again between 1/4/2007 till 1st April 17, which was for the northeastern states. So again, that is also not relevant, but it was given in your module, so I'm just describing it. But these are the main relevant deductions what are there for your particular attempt. And then we will do the 10AA. But before that, there is one more deduction which I would like to cover here is 10AA. We can cover it separately also. 1 second. ATLA. Now, ATLA is available to the assessees having the scheduled bank, having the offshore banking unit in SEZ. So, scheduled bank having offshore banking unit in SEZ. Then income from the businesses of the bank which are located in SEZ, or income from a unit of IFSC which is located, and income arising from the transfer of an asset being aircraft or helicopter or engine of an aircraft which was leased by a unit of IFSC. So here you can write down IFSC unit. Okay. Now here also 100% deduction is available. 100% deduction is available for 5 years, and thereafter 50% is available. 100% for 5 years and later 50%. For IFSC, it is 100%. For IFSC, it is directly 100%. And that is for 10 out of 15 years. For 10 out of 15 AYs. Okay, for the unit of IFSC, this is 10 out of 15 years. Correct? So these are the deductions which are available for the entities. Okay, for specific business deductions which are there. Next is in terms of the 10AA. 10AA is not covered under chapter 6A, but since it is similar, I will just cover it over here. 10AA is for the SEZ. 10AA is for the SEZ with SEZ manufacturer. The eligible assessee is SEZ manufacturer, manufactures or produces articles or provides services and exports such services or article, who manufactures or provides services plus exports. The deduction is available for 15 AYs, beginning with the year in which manufacturing is started, and the quantum of deduction which is available over here. Quantum of deduction which is available over here is profit derived by the SEZ unit from export business into export turnover divided by total turnover. So this is the deduction which is provided. And then 100% of this amount, so this is your qualifying amount. So 100% of qualifying amount for first 5 years, and then 50% for next 5 AYs is allowed. Are we clear? Right? So these are the deductions which are allowed. Okay, now there are some questions. I'll take it up. ATTTA will do it at the end, Jacob. ATG, ATGG, all of these are available whether to the resident or non-resident. So here they say just the assessee. They do not specify whether it is a resident assessee or whether it's a non-resident. So it just says that the amounts will be allowed as deduction. Now ATG is available to the assessee, which means all the assessees which are there. With respect to ATGG, again it says assessee, which means all the assessees which are there. Similarly, ATGGA, which is there, this is in respect of the scientific research. Again, it says assessee only. It does not say any non-resident or resident. ATGGB is for the Indian company. ATGGB, which is for donation to the political parties, for only the Indian company. And ATGGC is for every other assessee. Clear? Okay, Jacob. 15 out of 20 AYs. 20 AYs which are there, in respect of which you are asking, basically, Kaushiki, you're asking, I think, for this one. This one, it's 3 out of 10, 10 out of 15. Where is it written? 15 out of 20 AYs. Which one you're asking, Kaushiki? I didn't understand. So this is ATIA, which is available for 20 AYs and 10 AYs and 20 AYs for the infrastructure project. And for others, it is 10 out of 15 AYs. So this means that, okay, you're asking the meaning for that. Okay, so this means that, Kaushiki, that out of the 20 AYs which are there, from where the manufacturing is started or where the industrial unit is started, out of which only 10 AYs will be eligible, or out of 15 AYs from when the production is started or when the industrial unit is started, out of that, only 10 AYs would be eligible. Any 10 consecutive AYs you can choose out of the 15 years which are available to you when the particular business gets started. Okay. In case of ATIA, which is there, there the deduction is available for, as I said, in case of the infra project, it is for 20. And in case of the others, it is available for the 10 AYs commencing at any time from where the particular business starts. Clear? In which the undertaking begins to develop or operate the infrastructure project. And for the infrastructure, it is 10 out of 20 AYs, in which the undertaking develops or begins the eligible business. Clear? Okay. Now, there are certain issues in the context of these deductions which are there, which is what we are going to discuss now. So there are certain specific issues on which usually the question comes in your examination and certain case laws on that particular front. Now, one is, can the inland container depots. Now, inland container depots are there for the exporters and importers which are located in the cities which are away from the seaports, right? So these are set up, inland container depots are set up to promote the export and import business in the country, right? Because they are not located near to sea. So they are located in certain centers which are away from the seaports. So now the question was before the Supreme Court whether inland container depots can be treated as infra facility for the purpose of 80IA. And the Supreme Court answered that considering that these inland container depots which are there, they handle the custom clearance, right? And they can be considered as inland port and they can therefore qualify for the infrastructure facility and therefore they are eligible for 80IA deduction. All these case laws are available in your module. So you may not, again and again, I may write it down, but you can just see from your module itself. It is in the case of Container Corporation of India Limited. So maybe you can just write it down in few words here so that when you are revising, it will be easier for you. ICDs are eligible for infra facility and qualify for 80IA. Okay. Then next question is in the context of the Supreme Court decision again in the case of Meghalaya Steel Limited, where the question before the Supreme Court was, can the transport subsidy, interest subsidy, power subsidy received from the government be treated as profits derived from the business or undertaking to qualify for deduction under 80IB? So these transport subsidy, interest subsidy, can they be said that these are specifically profits derived from the undertaking, because only the profits derived from the undertaking are eligible for deduction. So the Supreme Court in that case answered that these subsidies were paid in order to reimburse the actual cost incurred by the assessee in the manufacturing and selling of the product. They have the direct nexus between the profits of the undertaking and the reimbursement of the subsidies. So these are the revenue receipts and they are specifically reimbursed for the cost incurred for manufacturing, and therefore these subsidies qualify for deduction under 80IB. So you can write it down over here. Export subsidies, power, transport subsidies are qualified for deduction under section 80IB as they are linked to profits of undertaking. Meghalaya Steels Limited Supreme Court. Okay. Next decision is in the context of Orchid Pharma and Liberty India, which is again a Supreme Court ruling, which is for the purpose that can duty drawback be treated as profit derived from the business of the industrial undertaking to be eligible for deduction. So in that case, the duty drawback, the Supreme Court observed that the duty drawback are incentives which flow from the scheme of the government. Now, ATIB provides for allowing of deduction in respect of profits and gains derived from the eligible business. So, incentives which are given the duty drawback scheme, they belong to the category of ancillary profits of the undertaking. They are not for the cost of manufacturing of the goods. So they cannot be credited against the cost of manufacture of the goods. And hence, duty drawback and the receipts and the DPB benefits which are there, they do not form part of the profits derived from eligible business and therefore will not be eligible for ATIB deduction. So you can write it down. Duty drawback receipts are not credited against the cost of manufacturing. They cannot be treated as profits from eligible business or profits derived from eligible business profits derived from eligible business. Therefore, they are not eligible for ATIB. So, the Act uses the term profits derived from and not profits attributable to. So, if you say profits attributable to, that is a wider term. Profits derived from is a very narrower term. So, here you can write it down. Word derived is narrower than attributable to. Word derived is narrower than attributable to. It's not profit attributable to the eligible business, but it's profit which is derived from the eligible business which is considered over here. Clear? So therefore, duty drawback receipts will not be allowed as the deduction. Okay? Okay? So therefore, this will be not allowed. This is Orchid Pharma. You can write down Orchid Pharma decision. So when in the exam you may get a case study on this or a case law on this, so you will write that ATIB provides that deduction, provides for deduction again. So since in Orchid Pharma, it was held that the duty drawback receipts are not profit derived from, because they are not linked directly to the cost of manufacturing. Okay. Next is another decision is in regard to, this is very interesting decision. which is in the context of the deeming fiction which is there. So the question before the Karnataka High Court was, can unabsorbed depreciation of an eligible undertaking, of a business, of an industrial undertaking which was eligible for 80IA, can it be set off against the income of non-eligible business of the assessee? Let's say I have the eligible business for which I am claiming 80IA. There is another business which is not eligible for any deduction. So can I claim the unabsorbed depreciation of the eligible business against the income of the non-eligible business? So that was the question before the Karnataka High Court. Now, here the Karnataka High Court held that the deeming provision contained in 80IA cannot override the provisions of Section 70. So the assessee had the loss in the eligible business after claiming depreciation, right? So therefore, he is not claiming 80IA because 80IA can be claimed only when there is a profit. So since there is no profit, 80IA becomes insignificant, right? And therefore, Section 70 will come into picture, whereby the assessee will be entitled to set off the loss from one source against the loss from another source under the same head of income. So the assessee was entitled to the benefit of set-off of eligible business loss against the profits of non-eligible business. And once the set-off is allowed under Section 70 against the income from one source under the same head with the loss from the another source, then Section 80IA will not restrict it. So loss on account of any unabsorbed depreciation has to be first computed while computing the profits eligible for deduction. In case there is no deduction, then you can set it off against another income. Clear? Are we clear? Any doubt? Any doubt? Okay. So you can just write it down here. Unabsorbed depreciation of eligible business can be set off against profits of non-eligible business, and deeming fiction of 80IA cannot override Section 70. Swarnagiri wire insulations. Okay. So 80IA cannot restrict in any manner the deeming fiction which is there. The 80IA deeming fiction cannot restrict in any manner Section 70. Are we clear? Clear? Next is, can the, let's say for example, if the disallowance is made for non-deduction of TDS, because of which the income has got increased, the expenditure is disallowed for 80IA, for any expense for which TDS has not been deducted, and because of which the income has increased. So can the increase in the GTI will be eligible for the deduction under 80IA or 80IB or whatever section under Chapter 6A. So CBDT has given a circular on this of 2016. That if the expenditure is disallowed, any expenditure, let's say for example, if I have not made the payment before due date of ITR, 43B will disallow interest expense. If I have not deducted the TDS, 40AI will come into picture and will disallow any expense. So if there is any disallowance which is made against the expenditure for which the Chapter 60 deduction has been claimed, the deduction needs to be allowed on the enhanced profit. So if there are disallowances made under 32, 40IA, 40A3, 43B, then Chapter 6A deduction will be allowed. The courts have held that the Chapter 6A deduction will be allowed on the enhanced profits of the eligible business. Right? But the CBDT has clarified that the deduction under Chapter 6A is admissible on the profits, so enhanced on account of such disallowance. So CBDT has also clarified that. So you can write it down. CBDT circular clarifies that income enhanced due to disallowances under section 40AIA or 40A1A, 43B, 40A3, then deduction is admissible on enhanced profits. Deduction is admissible on enhanced profits. Okay. Then next particular case is in the context of whether, let's say for example, that there is a company or there's an assessee who has not claimed deduction under 80IB in the initial years and start claiming the deduction for the remaining years during the period of eligibility. Can he do so? So the Delhi High Court had held that provisions of 80IB nowhere stipulates that a condition that the claim has to be made from the first year of qualification of deduction. And you cannot claim it in the remaining years. Nowhere it restricts that. So where the deduction is nowhere restricted, therefore 80IB should be allowed for the remaining years during the period of 20 years or 15 years or 10 years, whatever is there for the assessee. He can claim the deductions even for the remaining years. It's not necessary that he has to start claiming it from the first year itself. Are we clear? So it's nowhere mentioned that you have to claim the deduction from the first year itself. Okay. Any doubt? Okay. Next particular case is in regard to, this is a Supreme Court ruling, a very recent ruling, where the question before the Supreme Court was that can an agreement which has been entered into by a firm with the government, and if based on the agreement, the work is done, a work is done in pursuance of that agreement. Now, if there is a conversion, of the firm into a company, can it be considered compliant with 80IA to qualify for the deduction? Now, 80IA section 4, 80IA section 4, which is there, 80IA subsection 4, which is there, it provides that it has two clauses. So 80IA 4 provides that this section applies to any enterprise carrying on the business of developing, operating, maintaining the infra facility, which is owned by a company registered in India, and it has entered into an agreement with the central government. Now, this agreement was entered between the firm with the government, and later on firm was converted into the company. So can it be said that here the agreement is by a company with the government? Can it qualify for ATIA? ATIA condition is what? That the company should have entered into an agreement with the government. Now the agreement is entered by the firm. Later on, the firm is converted into a company. Right? So in this case, did you understand the question? What is the question? So the assessee company is converted from a firm, but the agreement was of the firm. Now the Supreme Court looked into the objective of the company from its memorandum of association, wherein it was clearly specified that it will carry on the business of the firm. And all the properties of the firm will vest in the company and the firm will cease to exist on the conversion. So the assessee company is qualified for the deduction under ATIA because it carried on the business of the firm and the firm ceased to exist on the conversion, and therefore the deduction was also allowed to the company. Deduction was also allowed to the company. Clear? Jacob, if you remember, well and good. If you do not remember, then you may just choose to not mention the case law name. If you remember the quote, you can mention. But whatever important case laws, what I'm writing it down for your reference, at least these ones you should remember. The names what I have given to you. Okay, these names you should at least remember. What I'm not taking the names, you may, if you remember, well and good. If you do not, then you can just choose to leave. Next, last case law is in respect of whether the period of exemption commence from the year of the trial production or from the year of the commercial production. And will it make any difference if the trial production was sold? If the sale was made out of trial production. So when the deduction will commence? So the assessee had started trial production and then sold some products of the trial products. But when the deduction will start? When the final production will start or from the trial production? So in this case, the Delhi High Court held that with the trial production, the manufacture does not start. It starts only with the commercial production. When the manufacturer finally starts or brings into existence the product and is fit for the marketing. Even though the assessee had made some sales from the trial product. And if it is established that the quality of the product was that it was into a marketable condition, then in the year in which, then in that particular case, the quantum of the commercial sale and the purpose of sale is not material. What is important is that the assessee had started when? So the assessee had started in the year 1998, where the commercial product started only in April 1998. So it has started the trial run in March 1998, but the commercial production started in the April 1998. So in this case, the court held that if the assessee established that there was a marketable quality of the trial products also, then the deduction is to be allowed from the trial run. So it is from the year when the trial run was started, then the deduction will be allowed from that year. But if the marketable quality is not produced, then in that case, the deduction will be allowed from the commercial production. Clear? So these are the case laws what were mentioned in your module. Now, few more things with respect to the ATIA and all of these deductions which are there. As I said, the set-off of the losses from the non-eligible undertaking can be adjusted while determining the profits of the eligible business. So in that particular case, what you have to keep it in mind. As I said, there is a ruling on this particular point that the deeming fiction will not override section 70. But in respect of the deduction which is to be claimed. Now, how will you claim the deduction under ATIA? Whether you will first set off the losses from the non-eligible business undertaking against the profit of the eligible undertaking to claim the deduction. You can set off the eligible business loss against the non-eligible. That is very much clear, for which we have the ruling, right? But the question is whether in case you can set off the non-eligible business loss against the eligible one to claim the deduction. That is the question. Eligible to non-eligible you can claim. There is no problem. But non-eligible to eligible can you claim? So, eligible loss to non-eligible you can claim. There is this ruling of Swarnagri, okay? But non-eligible to eligible, can you claim this loss for the purpose of computing the deduction? So here, first compute the deduction and then claim the losses. So first you will compute the deduction and then claim the losses. Before that, you will not compute the losses. Before that, you will not compute the losses. Okay. So in computing the profit of the eligible business, the business shall be considered as the only business of the assessee. So in computing the eligible business, profit, the deeming fiction is created. The deeming fiction is created by which the eligible business shall be considered as only business of the assessee. So because of this particular deeming fiction, there was a question before the court in the Swarnagri case that whether this deeming fiction can be extended to say that even the eligible business loss cannot be set off against non-eligible business loss. So in that case, in Swarnagri it was observed that eligible business loss, once we say that there is an eligible business loss, there is no deduction. And if there is no deduction, the deeming fiction cannot extend to section 70. But when I am computing the deduction under ATIB, then I have the restriction of ATIB which says that you compute the business profit as if this is the only business of the assessee. Then I cannot set off the non-eligible business loss. I will have to first compute the deduction as if the eligible business is only business of the assessee. So first I'll compute the deduction, and if there is any profit left, then only I will claim the losses. Is it clear? Is it clear? Okay. Now, in terms of section 80IA, 80IB, as I said, with respect to the 80IA, 80IB, you have to remember that what is the profit percentage which is allowed, the 100% which is allowed, the number of years for which you can claim the deduction. That is what you have to remember. And most importantly, you have to remember these case laws which I have shared with you. Now, last one, in terms of section 10AA. In terms of section 10AA, which I have discussed over here, here also there are certain important points which we can just consider. What I said is, what is the qualifying amount? Profit derived by SCZ unit from export business into export turnover divided by total turnover. Now, this export turnover is the amount realized in convertible foreign exchange within 6 months from end of the previous year. Within 6 months from the end of the previous year, and export turnover excludes telecom charges, freight and insurance charges, charges for providing technical services outside India, so export turnover and total turnover both excludes these amount. Okay. Total turnover also excludes duties and taxes. So this is very, very important because you may get the questions on these. The numerical questions may come on this. Okay. So export turnover divided by total turnover. Now, also here, you may remember that the deduction under these sections is from the chapter 6A. Therefore, only so much of the profit of the eligible undertaking, which is included in the GTI, shall be only available for the deductions. Clear? Now, also you may just write one point over here. If assessee claims tax regime under section 115 BAC or 115 BAB or 115 BBA, then deduction under section 10 AA, ATIA, ATIAB, ATIAC, ATIB not available. ATLA is available. Okay, so these deductions will not be available. Okay, so these deductions will not be available. Now, what we have done is we have completed the ATIA provisions. Okay, now what is left is, so we have done the profit link deduction. Now, few things are left. What are the things which are left? I'll tell you. So what we can do is maybe we can cover it in the next class. So next class, I will not be taking it up. It is on the charitable trust, but I would be taking on 6th, which is the class on the assessment of various entities. There, what we can do is we can cover the balance of the sections what are remaining. So maybe you can just write it down. What are the sections what we have to cover up? One is in relation to the, one second, let me tell you. So ATIA we have covered, ATIAB we have covered, right? ATIAC we have covered, ATIB is covered. So what is remaining is ATJJAA 1. Then ATLA we have already covered, ATM and ATP and ATPA, ATQQB, ATTTA, we can just cover it now, ATRRB. So small ones, I'm covering it now. We'll just extend for 5 minutes and then we will close the session. So then only will be ATJJB, ATP, ATPA. Okay. The next one which I'm covering with you is ATTTA. ATTTA is for the interest on deposits in saving account. interest on deposit in savings account. So for this, who is eligible? This is provided to the individual or HUF, and this is up to rupees 10,000. 10,000 deduction is allowed for the interest on the bank deposits with the bank, cooperative bank, or a post office. Okay. This is not available to a senior citizen. Okay. Then 80TTB is there. This is for the senior citizens. Senior citizen is again the resident individual over 60 years, right? And if they have the income on the deposits, this is on the saving account. So this is fixed deposit plus savings. Both are covered over here. And deduction is up to 50,000. Deduction is up to rupees 50,000. This is under 80TTB. Are we clear? Jacob, you can clear the doubts with me on Wednesday in respect of this particular topic. Okay. Next is 80QQB. 80QQB is deduction in respect of royalty income of the authors of book. Of the authors of the book. Now, this is a deduction of rupees 3 lakh. Rupees 3 lakh is allowed. This is allowed to individual or rather a resident individual. This can come as a part of the international tax question, resident individual. So here deduction is the income derived or rupees 3 lakh. 3 lakh or income derived, whichever is less. Right? So this is the income. Now the income is by the consideration for the assignment or grant of any interest. The book should be any literary artistic book, and the deduction is allowed for that. As I said, the deduction which is eligible here is on the royalty or copyright fee received before allowing any expenses which shall not exceed towards the 15% of the value of book. Next is 80 RRB. This is again allowed to the resident individual. And this is in respect of royalty on patents. Royalty on patents. Here the deduction again is allowed is 3 lakh rupees. Rupees 3 lakh or the income whichever is lower. Are we clear? So these are the two deductions which are allowed on 80QQB, 80 RRB. Now 80P and 80PA is in respect of the cooperative society and producer company. This we can definitely do while we are covering the assessment of various entities topic. 80M is for the dividend. Again, that we will do it in the next class. And last is 80JJAA, which is for the employees. That also we will do it in the next class. Other than that, we have finished everything. Last one point which is remaining is in terms of 80IA, 80IB, all of these sections, any transfer of goods from the eligible undertaking to a non-eligible undertaking has to be at the fair market value. Are we clear? And all of these deductions under 80IA, 80IB, all of these can be claimed only when the return of income is filed before the due date of return of income under 139(1). Clear? Just remember these 2 points. 80TTA is available on interest on saving account. Yes, it is available. That is on interest on saving account only. Thank you, Kaushiki. Okay, students. Thank you, Jacob. So I'll see you on 6th again. In between, you have charitable trust class. Thank you so much. See you next Monday.